This is E2B, Energy to Business, a podcast by Opportune, where we bring you in-house expertise that serves all energy sectors. We examine emerging financial and technology trends and provide a broad perspective on ways to stay ahead, create opportunities, and execute market strategies.
Hello, everyone, and welcome to another episode of E2B, Energy to Business, an Opportune podcast. I'm your host, Daniel Litwin, the voice of B2B. And folks, thank you so much for joining us on another episode of the show as we continue to explore the hottest technologies, trends, and market-moving topics that are shaking the larger oil and gas and energy industries. As we jump into today's topic, which is going to be very macroeconomic in scope, I want to make sure that you're getting all of your resources here to support our conversation, to give you some more touch points to understand the topic we're breaking down, but also to get some more E2B and Opportune content in general. So to do all that, head to our website, opportune.com. Again, that's opportune.com. There you'll find white papers, blogs, research papers, articles, videos, podcasts, you name it, on a number of topics, including this one. You can also find episodes of E2B on our website, and you can find more episodes of E2B on Apple Podcasts and Spotify. So just hit that subscribe button and you'll have a full catalog of previous conversations, plus notifications when we drop new episodes. All right, let's go ahead and jump into today's conversation point. So like we've done on the show before, obviously, we have a great pool of thought leaders at Opportune. They have a lot of expertise, and they keep their ear to the ground and their eye to the skies, and they are often the ones that are, keeping the best pulse on what is shaking our industry and why it matters. So again, like we've done on the podcast before, we're going to be basically providing a podcast version or an expansion on an already existing article on our site. So I'll point you to our site. You're going to want to check out the article, "The Fed's Fight Against Inflation, is WTI crude oil recession proof? This is by Ryan Dusek. And we're going to be expanding on this topic of inflation and of the macroeconomic consequences of inflation and some of the potential solutions on the larger oil market. If you haven't been paying attention, or you have and you just want the refresher, demand destruction has been the Fed's mission statement all year, right? That is the goal for the Fed when dealing with inflation. Fed Chair Jerome Powell has said over and over that inflation must come down to 2%. U.S. CPI inflation was 8.3% in August, which means that, of the range of solutions available, the Fed's rather limited solution pool of monetary policy strategies are unfortunately going to keep up the pain for consumers and for businesses whose debt just got a lot more expensive as they continue to tackle this high level of inflation. And Powell is issuing warnings that this is just the beginning, right? We've already seen several interest rate hikes this year, but he's letting businesses, consumers, and investors alike understand, he's letting them know that rates will only keep increasing. Latest projections put the federal funds rate at 4.4% by the end of the year, and that could reach as high as 4.6% by 2023. So now we got to intersect this with our audience here, right? What is this doing to oil markets, and how is this shaping the nature of inflation and oil prices as other supply side factors also compound and shock oil prices? So here for analysis, we're joined by the author of the aforementioned article, Mr. Ryan Dusek. He's a director at Opportune. Ryan, great to have you on, man. How you doing?
Doing great. Glad to be here. Great topic.
Yeah. Oh no, it's one that I've been following more closely as of late. In my own reporting, I have been trying to keep a pulse on some macro trends, which includes the Jackson Hole Symposium, the various interest rate hikes, and some of the proposed policy solutions and how they impact business demand. But all of that to say, yes, very interesting topic, a lot of layers here. So just for a little more context before we get into conversation, and again, I encourage our audience to crack open that article, "The Fed's Fight Against Inflation, is WTI crude oil recession proof?" It'll give you some great visuals and more context to follow along. So yeah, what a year it's been for the U.S. economy, right? Last year, the Federal Open Market Committee gave a pretty picturesque view of the economy. They said inflation was, quote, transitory. It would likely fall to 2% in 2022. Things are fine, right? We're coming out of the COVID pandemic, and we are on a recovery path. Well, fast forward to today, and unfortunately, that didn't come true. Inflation is over a 40-year high, and the FOMC is now playing catch up with one of the fastest Fed fund rate increases on record, subsequent increases, right? On the 21st, the Fed raised its interest rate by 75 basis points for the third time this year, and it reached a range of 3 to 3.25%. And like I mentioned earlier, Mr. Powell is signaling that more large increases are to come. So Ryan, let's get your analysis here. What went wrong, right? How could we go from things are fine, we're going to fall to 2% in 2022 to now increase after increase after increase and a pretty persistent high level of inflation? Thoughts?
Yeah, it's real interesting. Kind of even going back last year, we did an article, or I wrote another article, and I called it hyperinflation. It was actually for a different reason. It was because nothing was happening, right?
Right.
No rate cuts at all. I mean, just because of how picturesque they thought the economy was. So everything was just too good to be true. We could tell at the time there's a lot of just commodity prices started to increase across the board. It wasn't any one thing. And so you can start seeing cracks, in the foundation, so to speak. It kind of all stems from just, this is political, no matter if you want to say it or not. And I'm not saying it's Democrat or Republican. It's just really both. Politicians love to kick the can down the road. No one wants to take responsibility for anything. Everyone wants to blame somebody else. So no one does anything. So this really kind of, in my opinion, started back in a little bit 2008, right after the credit crisis. The Fed had a plan. We had the economies crashing, stock market crash. So everyone, what's going on? Fed decides to inject money, stimulus into the economy, lower rates, make things more liquid, basically kind of jump-started, if you will. So that started, they had kind of one round of quantitative easing, injected a couple trillion. Then they had a second and third round. And really that kind of continued all the way through 2014, 2015. So rates are lower, easy money, people are spending. The plan was originally to take some of that back out of the system. So they started to do that around 2018. Had a bump in the road, didn't know exactly how much liquidity they would need. So they had a few problems. The market started collapsing, so they went back in. And then to make things worse, shortly on the heels of that, we had COVID coming around. That was a lot of fun. More money into the system. So it's been just increasing. Since I started in 2008, it's been, I guess, close to $8 trillion that they pumped into the system. So easy money makes things very cheap. And so prices were going up. And we just kind of saw that progress. COVID has some supply issues across the board again, not just in energy. So that led to some of the inflation as well. So it kind of, for the most part, put the Fed where they are today, kind of between a rock and a hard place. And so if we kind of take that down the road a little bit further, it's back to the point now where, they have to do something. Everyone wants to blame Powell for his decisions, but I don't actually see a lot of other decisions there, other than maybe go slower. I don't know. It's a tough call. I don't know exactly what numbers they're looking at, but overall, it's a very interesting situation now, and it's come a long way in that 1 year period. And my views have changed a lot. Most of my views have changed a lot. Some of them, I still have the same outcome, but for different reasons now. So it's been interesting.
Yeah, interesting. Definitely an understatement. Just with just so many layers that are, shaping or that shape inflation or continuing to shape inflation. I think it really, like you said, it puts the Fed in a difficult position because, especially when so many of the reasons why we have inflation are supply side. Monetary policy, demand destruction is not really going to fundamentally address those supply side issues. And so, they can do what they can. But, then you weigh the consequences of, okay, we can continue to raise interest rates. But if that, ends up leading to record unemployment and a mass recession, was it worth it to curb inflation? Right. And so you really are walking this tightrope. And you just hope that the people passing the policies have that in mind and realize the consequences in one way or another. But one of the consequences that I guess you could say is somewhat of a silver lining, I guess, but that also creates some geopolitical currency, I guess, challenges, is that rapid increases in interest rates are strengthening the US dollar internationally. Can you give our audience a little more perspective and context there on how the dollar is correlated with, well, first, if you could break down why we see that, right? As interest rates increase, why does this even strengthen the US dollar on an international stage? And then we'll start to bring in more perspectives on the oil markets.
Yeah, so as the Fed's raising rates, it's basically what that's doing is making goods, U.S. goods, or any type of good denominated in the dollar more expensive. So as it's getting more expensive, specifically in this case, like focusing on WTI, crude oil is denominated in dollars across the globe. So relatively speaking, we should have seen pressure on WTI. And to an extent, we did for a while. So it's been a real interesting, I guess, decoupling, or at least temporary for now. At some point, it'll kick back in. But the fact that as rates have been going up and crude oil is continuing to go up, there's a problem there. And so this tells me that it's specifically a supply side problem. And so if we can't do anything on the supply side, raising these rates really won't matter. It'll at some point kill enough demand, but prices won't come down. So that's one that I was looking at pretty closely because it was just a little backwards. It's just not what you were expecting. So kind of dancing around that supply side issue. Everyone's focused on demand destruction. And so no one's really paying attention to what's going on the supply side. So that's kind of the wild card that we need to watch.
Yeah. And I mean, let's just stay on that topic here for a second before we get into some of the oil context and intersections here. There are a lot of factors influencing some of the supply side challenges, which include leaks, right? I guess like metaphorical leaks from the COVID pandemic and its crisis and its disruption of supply chains and geopolitical relationships. All of that is still being felt. On top of that, you have sort of freak supply chain accidents like boats stuck in canals and ports on the coast of California being backed up for months at a time. Even if that was months ago, reverberations from that are still being felt and still, increasing prices. We also see things like drought across the United States, crushing yields, which are impacting the prices of fertilizer and the prices of feed, which then means we have higher meat and higher prices for meat, higher prices for crops. All of that's contributing to inflation as well. And then, of course, the big one is the Ukraine-Russia conflict, which is creating a lot of instability in Europe, but that is, leaking its way over into U.S. markets, which naturally also leads to inflation. So that's my summary there. Did I miss anything? Is there anything, Ryan, that you want to add there? Or, what should we be keeping our eye on supply side wise as we deal with hike after hike after hike on the demand destruction side.
Yeah, no, I think that's very, very accurate. There's really two places that I think that we're going to see this inflation come from. One is on energy, but the other one is it going to be food? Those are really the two that are going to Americans are really going to feel the pinch. There's, like you said, there's cycles that, especially with, really with any of the commodities. But if you're talking about growing something, whether it's grain, wheat, or even cattle, there's a cycle that everything goes through. So recently, we had the big drought. Farmers had a hard time finding feed for the cattle. So all of a sudden, tons of cattle were going to market. Prices get depressed. But again, that's going to be a cycle. So what does that mean for next year? So, people sold more than they cared to this year, getting a worse price. Next year, they won't have as much to sell when the prices are better. So we know for sure, not 100%, but my guess is that we're going to see a lot of the meats prices go up. Really, all the agriculture, I think, is going to go up. There's just a series of events, and it's always like that perfect storm, where it's not just one thing, but it's kind of a trickle effect. It's like you push that first domino, and then you see everything start tumbling down one after another. But that's going to occur. I'm confident in that. And that's actually some of the two things that I looked at specifically when I was trying to address, how much, what is peak inflation? Are we there? Is what they're saying real? So that was all part of a much larger analysis that I went through. But yeah, I think it's definitely coming, and I think you're spot on.
So now let's bring in that oil angle here. We've also been seeing some supply side challenges to, or I guess, impacting oil pricing as of late. Before we get into that, let's connect the dots between interest rates, strengthening the US dollar, and then impacts on crude oil pricing. Can you explain to our audience how the dollar and its strength or weakness is correlated with crude oil pricing, and what we can expect moving forward with that context in mind?
Yeah, no, that's it's really interesting because crude is denominated in dollars. It should be getting cheaper right now. So as the Fed's hiking these rates, that pressure on the dollar, that stronger dollar, relatively to other countries not denominated in dollars, USD, everything will be more expensive. So there should be an overall global decline in usage, you would think. And so normally, like we've seen specifically in the 80s, was a really probably a clear-cut example when the dollar was extremely strong, and then crude oil was about $10 or something, so extremely low. So that relationship does exist. It will exist, and it just decoupled at least for a little bit right now. We did see the crude oil come off some after pandemic, but it's still doing what it shouldn't be doing. And in the midst of everything that's going on, and I think most traders or crude traders are worried kind of two things, right? So one is they want to be positioned for the next political disturbance, right? So if something goes on with Russia, Ukraine, they want to be positioned to take advantage of higher prices that result from that. But on the other side, they're also trying to be as nimble as possible because every time the rates go up, there's a better chance that the stock markets, the equity markets, the debt markets, really, there's a fairly good chance at this point that we might see more of a collapse kind of across the board. So, it's kind of, you're really kind of walking a tightrope. Do I worry more about the supply side? Do I worry about demand? And just because of everything that's been going on, demand's taken center stage. Any supply issues we have, it won't be addressed quickly. A lot of that is, there's a lot of reasons for that as well. A lot of it's just coming from just policies, right? The Biden administration took over. Energy was not as sexy, if you will.
Sure.
So a lot of the policies that were put in place kind of dampened that. change the rules in the middle of a game, if you will. So anytime we see something going on, I don't think you're going to see that quick of a response from producers, just because they're weary. Like, well, what's going to be the next thing? If I start spending money deploying capital, am I going to get my return on that or not? Or we're going to just say, oh, you know what, we're good again. We're just going to slow down. Can't do it anymore. There's other things as well, like the ESG initiatives. Those are they're basically a tax, right? It's just none of it's going to make anything cheaper, but it will make everything more expensive. So that can't help in any way the inflation problem. And I think at some point, it'll break. The system's going to break, and people are going to realize, like, do I really need to pay for all of these costs associated with what I want to buy? And then I guess my favorite one most recently is the Strategic Petroleum Reserve. So, let's artificially lower prices. We'll dump a ton of crude on the market, lower prices, and then we'll all be better. I think it was just 2 days ago, after they've already made the largest pulls ever by any president. I think we're at the lowest levels ever at this point.
Mm-hmm.
They said, no, we're done. We're not going to do it anymore. And yesterday, they kind of reversed that after OPEC said, you know what, we're going to cut our production. So we have a lot of things leading to higher prices, and all we need is a spark. I think we're just kind of at that point right now where a little spark will go a long way. I wrote this article like a week ago, and I think prices were $78 at the time.
Right.
Today they closed at looks like $89 right now. So what a difference a week makes. So we're seeing that already coming through. That is a very tight supply picture. I don't know how you rein in those prices without addressing supply issues. And I'm a little concerned that we have this kind of two different views. Powell has one objective, and then the administration has another objective, and they're competing. That's kind of the biggest issue. They're just competing with each other.
Well, and you brought up OPEC Plus and its cutting of I think it was 2 million barrels, right? Is that the final number?
Yeah, 2 million.
2 million barrels being cut in production to bolster falling prices. If you had to look ahead and sort of weigh the I don't know, at least just over the next few months, the implications of that production cut coupled with low strategic reserves, coupled with, X, Y, and Z, all the other factors we broke down today. What can we expect to see in the coming months heading into 2023 concerning crude prices? Again, especially with some of these significant production cuts.
Yeah, and maybe this is kind of bring it all together as well, because, a lot of what I looked at was the end game was to look at what's going to happen in crude. We're going up, we're going down, because it's just in that kind of cross currents between everything. And so with the Fed moving the dollar, I really wanted to say, okay, let's say the dollar continues to go up, which I believe it will. I'm thinking the dollar index is what I'm looking at. I think it'll probably crack 120 or so. I think it's about 114, 115 now. It's already had a huge run up. And so if I'm think it's going to hit 120, 122, whatever my target is, I was really curious as to see, well, based on what's happening in the market today, as this dollar's getting stronger, crude's getting stronger, inflation is up, we're trying to tamper that down. I basically very curious, so I modeled it out. I said, let's simulate this. Let's figure out what's going on. So I kind of built a model around the CPI data, and I really wanted to see, like, okay, what would it take? Is it possible to get to that kind of 122 on the dollar index, which let's see what inflation level would look like if that did occur. And so as I run through a bunch of iterations and come out with some results, and I was actually a little surprised because the end game was like, yes, we can get there, but it wasn't like, hey, this is kind of a 3 sigma event. It was like, it's outside of normal, but it's really not that hard to get there from where we're at today. So that worried me a little bit. And so I really kind of broke it down and started focusing on food and energy specifically to see what would occur there. And that's really where the drivers were. And it's, the fact that it was very doable. overall inflation, they're saying it's like 8.9%. I don't think we're there yet. A lot of people said peak inflation, we're done. Market's going to be okay. I just don't think that's the case. I think right now we're beyond, even with their own metrics, we're beyond the 8.5%, 9%. And I think that next tick up when that CPI comes out and we actually go above that 9% threshold is really when we have a lot of problems. But in the end, because we're not addressing supply issues, I think long term, I think we could get all the way up to possibly 30% ish, right? So, which is, going back, and I don't think it's ever printed 30% inflation, but, I don't think we've ever been in a situation like we're in now. So it's a lot going on. It is feasible. And I think crude prices are going to go up probably sooner rather than later. Like I said, we've seen $10 increase in the last week. So I think short term, by the end of the year, probably over 100 by the end of the year, potentially more if anything takes off geopolitically. Like I said, I think we're set for that. But I honestly think we'll be at $180 probably first quarter next year. It wouldn't surprise me at all. And then, who knows from there? At that point, when you start getting to those extremes, those tail events, there's not a lot of difference between 180 and 250. It's just right. Blink of an eye. So I think we're definitely in for a world of hurt. Energy prices are going to be up to the winter. It's not going to be good for consumers. It's going to be a rough, at least in my opinion. I think it's going to probably be a pretty rough, pretty expensive Christmas time. And then hopefully it'll kind of wane a little bit. But I'm not painting a very rosy picture, but that's just kind of what I see today and just where we're at.
So do you have any advice then or strategies for producers out there, for our audience that, has their hands in the oil and gas industry, whether it's on, again, the production side, the market side, or they're, listening in and they're recipients, right? They're in their energy intensive industries and oil prices are going to impact their energy bills. How do we maneuver this next phase? And do you have any strategies again for the industry to, to sort of field or weather some of the potential consequences that might come from higher prices, whether that's strain on some of their relationships, their B2B relationships, again, just general cost of doing business. Any thoughts there?
Yeah, I think higher prices are generally, honestly, good for the energy industry.
Right.
So our producers, oil and gas, they're going to be just fine. They won't have any issues, any concerns.
Right.
At some point, the administration or overall, there's going to be a change in view. You can't say, fossil fuels are bad and just end them today. But we've seen some of the effects of trying to bring on all the renewable energy at one time. All of a sudden we had a great Texas freeze. There's, I guess my favorite one is like you're looking at these hurricane impacts and all those trucks that they have going around there. That's not electric trucks. You still have a need for good old gasoline and gas powered engines. So, there's a time and place for everything. I don't think everything needs to be switched at one point, just all at the same time. The system can't withstand that. But so energy wise, I think higher prices be great. Producers will be wonderful. Now, some of the other areas like gasoline, using crude as an input, those are going to be higher as well. And we're kind of stuck with refinery. No new refineries are being built or have been built in quite some time. So you expect higher gasoline prices as well, especially going into the driving season next summer. I kind of feel like it's going to be pretty much from this point all the way into the driving season. Prices are going to continue higher. So as far as any other industries, airlines, for example, they're going to be a taker. Plane tickets are going to get more expensive. You're just going to see, they're probably still reeling from COVID, and you see more and more people trying to jam on every plane. But that's going to be another one you're going to see a lot higher prices on, just trying to be able to travel. And again, like you were saying, natural gas is a big input for fertilizers. And so that's going to go into your higher cost of of all the food as well. So it's all connected, and it's all moving, unfortunately, in the same direction, which is up.
Yeah. And like you said, higher oil prices will mean different things for different industries and even different segments of the larger energy industry and oil and gas markets. So now we need to wrap things up by addressing what's to come a little bit more. In your article, you mentioned, based on your analysis, that you don't even think we've seen peak inflation yet. This is something other economists are saying. And, I think with the supply side instability we continue to see, whether it's geopolitical or supply chain related, that this could very well be possible. The current 8.3, 8.5-ish% inflation rate could very well double, to beyond 20%, which might seem a little inflammatory, but let's back that up, Ryan, with any analysis or perspective you can offer. Why do you believe we're not even really scratching the surface of the inflation that's to come here over the next year? And what are some of the broader implications of that hyperinflation macro environment on energy prices and on our audience's industries?
So, yeah, the 8.5%, I think most people are, at least there's that feeling that we're done, right? We ticked up a 9%. We turn back down 8.5%. Hey, inflation's over. I don't think it's done, and a lot of that is just because of some of the analysis I did. And honestly, I'm just really curious. This is not part of my normal job per se, but really curious about what these impacts will be. And so I did a lot of modeling on financial modeling, built some simulations to see what could happen. And I focused on really just CPI, and kind of in a relative world, with the rates increasing as fast as they do, the dollar strengthening as fast as it is, what type of inflation would that be? Or what type of inflation would support that type of strength in the dollar? And that's really why I start believing that, this 8.5%, that's not it. Like things are happening way too quick. And then there's going to be a huge lag by the time everything filters through. But energy and then food were really the two drivers. Those were between those two components of the CPI, that's how we can get there. And again, it goes back to really a supply issue. When no one's addressing the supply side, it makes everything a lot worse, because we're, on one hand, we're killing the economy, trying to bring that down. But on the other hand, we won't do anything about supply. It's not allowed. It's not convenient. There's all these different reasons about why we don't want to do it. But if we're energy dependent, it solves a lot of problems. We just need to turn on the spigots again and get some oil flowing. I think that'll be the big key to kind of bringing this all down. But we're not there. It's a world of hurt still coming.
So to leave things on an optimistic note, then anything we can leave, with giving our audience a sigh of relief, right? Anything that might encourage a little optimism, whether it's in, inflationary pressures, supply or demand side, or even just any of the silver linings on the consequences to the oil and gas market.
Ooh, that's a tough one.
Yeah, right. yeah, tough to find optimism. Oh gosh, yeah.
I'm just pretty bearish overall on everything. It's just there's so many signs in the economy right now and it's not just energy prices, it's just across the board. And there's a lot of things I worry about with just the financial systems strained. You're seeing derivative problems in these very large banks. And so generally, if you see a derivative problem in like a Credit Suisse, for example, they have counterparties to that, right? So some other bank is getting affected. And that anytime you're dealing with this massive amount of derivatives, all these players are all linked. So truly you have a domino effect if one goes down. So for me, I think the one bright side would be if you like Bitcoin, I think that this might be the point where Bitcoin decouples from being a tech company or trade like a tech company. If you have some issues with the banking system, that might be the next time